This webinar will begin soon. Hello, my name is Meredith Carbrey and I am a Senior Wealth Advisor at Bedel Financial Consulting. In this session, I will discuss the changes to itemized deductions under the 2018 Tax Cut and Jobs Act. The standard deduction was almost doubled and is now $24,000 for those filing married, filing joint. Given the significant higher amount, more people will decide to use the standard deduction instead of itemizing. Over the next few slides, I will point out the changes to itemized deductions, which will hopefully help you determine if you will itemize or take the standard deduction. So what we're going to do is go through each itemized deduction that you will find on Schedule A. So the first item that you could deduct are medical and dental expenses. So you can still do that, but there are some changes. So actually it was reduced from 10% to 7.5% of your adjusted gross income. And this is actually one deduction that you can use in 2017 and then 2018. However, this deduction is not for very long because after 2018, so when you file your 2019 taxes, it reverts back to 10% of your adjusted gross income. One of the big changes to the itemized deductions is for state and local taxes. You might often hear people refer to these as the SALT, which is state and local taxes, income, and any property tax deductions. So what you can do is all of these are aggregated and then capped at $10,000 for those married filing joint. So that is a big change for a lot of people. If there are any state local taxes that you're actually scheduling on C, E, or F, those are not capped. So like rental property, things of that nature, you would not need to worry about this cap. Home mortgage interest. So this is another change, but many people were pleased to see that you would still have the ability to deduct home mortgage interest. So now you can only deduct interest on mortgages up to $750,000 that were used to buy, build, or improve your home. However, if your mortgage originated before December 15th of 2017, you can still deduct up to $1 million of that interest. And then to make things even more confusing, in year 2026, the mortgage interest deduction cap reverts back to $1 million regardless of when your mortgage originated. One thing that will be disappointing for a lot of people is that home equity line of credit interest is not going to be deductible in years 2018 through 2015. Charitable donations, those were also changed, and we have a whole presentation on charitable deductions, so I hope you have time to watch our other video, but I did want to point out a few items. First of all, the donation deduction for cash donations was increased to 60% of income from 50%. So that's a nice bump. However, if you make donations to a college in order to purchase athletic tickets, you can no longer deduct that donation or the purchase of the tickets. So that is a big change for people. Casualty and theft losses are no longer deductible unless the loss is due to a federally declared disaster, like Hurricane Harvey or Irma. The job expenses and miscellaneous deduction, subject to 2% of adjusted gross income floor, is completely repealed. So if you were taking deductions for unreimbursed employee business expenses, such as mileage, or using part of your home as your office, you can no longer deduct those. Other things that you can no longer deduct include tax preparation or investment advisory fees. So from years 2018 to 2025, your itemized deductions will no longer be limited based on your adjusted gross income. So you do not have to worry about any sort of limitation on your deductions anymore. Thank you for listening to my presentation on itemized deductions. I hope you found this information helpful and that you listened to our other presentations as well. Please consider following us on social media and sign up to receive our blog. There's lots of great financial information on that weekly blog. Thanks again.